You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Options Bootcamp is brought to you by NASDAQ. From its inception, NASDAQ has been an innovator and agent of change in the financial markets. It's in our DNA. From the development of electronic trading to our drive to bring enhanced functionality and world-leading technology to our suite of 6 options exchanges, we exemplify customer focus, consistent technology, and streamlined solutions. NASDAQ, tech forward, leading the U.S. options market and continually rewriting tomorrow. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and Jill Malandrino.
All right, everybody. That music means it is time once again for Options Bootcamp. Yep, it's back in the rotation. I'm glad to see that you guys are enjoying it. We're working to get it out to you every week. So no longer do we have to field the questions. Where's Bootcamp? What's up with Bootcamp? When are we going to get another Bootcamp? Every week for the foreseeable future. That's the plan. So we're cranking them out. Glad to see you guys are enjoying them. These are certainly the times when I think we all need a little bit of Options Bootcamp in our lives, and certainly a lot of the Q&A segment as well. So we'll be getting to all that in a little bit. I mentioned at the top of the show, Miss Jill Malandrino is not joining us today. She's off running the trade talks over there in NASDAQ land, but we got some able people to fill in the NASDAQ hot seat. And this is also where I'm usually joined by our good friend, the black-hatted one, Mr. Dan Passarelli from Market Taker Mentoring. Unfortunately, right before showtime, Dan had an emergency, and he had to hop off. So hopefully things are going well with him and his family in these crazy times, and we'll get Dan back on again soon here on the old boot camp. But joining me, so it's not just me fielding all your questions and comments and inquiries. It's our old friend holding down the NASDAQ hot seat today. A little bit of a different scenario for him. Mr. Russell Rhodes from EQ Derivatives. Mr. Rhodes, welcome to Options Bootcamp for the first time, sir.
This is, I guess, a trifecta. Is this the third program I've been on with your network?
Well, let's see. VolViews and TWIFO and now Options Bootcamp. Have you done the option block?
I don't think I've ever done the option block. And I think I never did because it's SIBO. You're really not supposed to give recommendations or anything like that. I could do it now. I am your utility infield player, and I can also pitch.
Yes, coming to us via the magic technology known as telephone. See the lengths we go to, listeners, to get you content during a pandemic. We're glad you guys are appreciating. If you like what you hear, make sure you leave a review in your platform of choice to continue the new folks coming in and downloading and streaming and enjoying the program. Before we keep going, Mr. Rhodes, you mentioned you do have a new business card. You are holding court over there these days at EQ Derivatives. Really quickly, break it down for our audience. What the heck is EQ Derivatives, and what are you doing over there?
EQ Derivatives focuses mostly on volatility trading products, people that are out there trying to figure out how to benefit from alternative risk premium or just any other ways that you might be using options in your practice. I deal with a lot of big buy-side firms, a lot of big pension funds that are looking to either enhance income or guard against losses using options. also working with a few of the exchanges and helping them with education on specific products as well.
We're going to get into your options drills in a little bit, but before we do that, really quickly, we are recording this on April 21st, listeners, so we're in the midst of a lot more madness. Pretty much pick a day that ends in Y these days in the market, listeners, and there's some madness unfolding somewhere in the broad market. Either we're selling off hard, maybe we're triggering circuit breakers, the vol space is moving like crazy, vol is skyrocketing, or it's coming in, or now these days it's in the commodity space. Of course, looming above all this is the global specter of the pandemic, so there's a lot to unpack. Before we get into some of our options drills and some of the Q&A in a second, Mr. Rhoads, just catch us up really quickly. What are your thoughts on this crazy market, this crazy volatility regime that we find ourselves in right now, sir?
And my thoughts about this volatility regime, and I'm in the minority thinking this way, and I get beaten up a lot thinking like this, but it's really, we're seeing a lot of the patterns from 2008, 2009 play out, at least within the financial markets, and especially with volatility and how the equity indexes are behaving. We're a little over a month since VIX peaked over 80, and if you superimpose a 2008, 2009 daily chart with a 2020 daily chart, the price action for both broad-based indexes and for the volatility indexes looks almost exactly the same, which can be a little frightening because the stock market didn't bottom out last time when volatility spiked.
Yeah, these are the parallels everyone is drawing these days, 2008 to now, because it is indeed the most recent meltdown we've seen and the most severe in the market. Of course, we're having all these other absurd ancillary things that are going on, which seems to be the case whenever there's a meltdown like this. Of course, these days it's playing out in the commodity side of the space. We're seeing this. First off, it was exacerbated by this epic price war between OPEC and Russia, effectively crushing the price of crude and, of course, trying to squeeze out U.S. shale oil producers as a result. Now we're seeing the ramifications of that and, of course, the just complete annihilation of crude oil demand. And as a result, we're seeing just crude oil, the WTI contract went negative, listeners. That's never happened. Some people never thought it even could happen. There are a lot of brokers who were unclear on that. CME had to contact them yesterday and say, wait a minute, it actually can go negative, and that hence there was a scramble for the exits out. They were paying you to take a barrel of oil off their hands. The sad part is no one's driving demand's annihilated, so people can't even enjoy the benefits of this very, very low oil price at the pump right now. So it's kind of just the worst of all worlds, annihilating the prices without any sort of broad benefit to the economy. Before we get into some of the other stuff, Mr. Rhoads, I'm just curious, have you been watching what's going on, particularly the impact now on some of these oil and energy ETPs like USO, sir?
Yeah, no, I spent a lot of time looking at this one yesterday, I think like a lot of people. And, one of the biggest misperceptions that was out there was somebody threw out there, actually a pretty reputable business publication threw out there that this was being caused by USO having to sell contracts, and that's not true.
Yeah, I saw that, and that was insanity to me. I was like, do the people not know how USO works?
Well, no, they actually roll. They finished rolling out of the May contract, which for people that don't pay attention to the energy markets, the May contract expired in April. But they had finished rolling out of the May contract on April 13th.
Yeah, they're done.
So USO owned no May contracts. They didn't get hurt by this. And I took a look at the Commitment of Traders report from, the data was just a few days old, but when you looked at the biggest position holders, the largest position was producers, and 36% of the outstanding open interest was short by producers. So I have a funny feeling that some of the big oil companies actually maybe salvaged a quarter or maybe two through having short futures contracts on. Problem is there were enough people that didn't want to take delivery of oil that basically had to bail out of that contract on April 20th and pushed it to negative. And I am always the first person that will admit when I don't know something. I had no idea that the futures contracts could go negative. It's not an area I've focused on in the past, but it just never occurred to me that it could happen. And thank goodness when I saw the May CL futures offered at 20 cents, and I had this thought, well, the most you can lose is $200. Thank God I did not pull the trigger and buy that contract. But I will guarantee you some people did.
Yeah, the wreckage that's going to come out of this, I mean, obviously funds are going to blow up. And you're right, we're far from the only person who didn't know that these could go negative. We heard a lot of rumors that CME was frantically contacting brokers saying, this thing can go negative. You got to get prepared for this. So a lot of people were scrambling. Again, these are the things that happen in these terrible environments, but they're also like the last thing anyone needs. There's already horrible things happening in the broad macro space and even here domestically. And then on top of it, we add fuel to the fire with these just extreme developments that were exacerbated by man-made conditions. Of course, this sell-off was all sparked by man-made events out there in the crude space, and now it's taken on a life of its own. That is interesting about the crude shorts. Usually Dan's here on the black hat / conspiracy theory / zero hedge seat. I guess you're taking over for him out there. But you're right. I encourage anyone who has questions about this, and we'll dive into this more later this week, of course, on TWIFO. This is not really a show to talk all things commodities, but it's just so top of mind for everybody right now that is kind of unavoidable out there right now. But yeah, USO did adjust their schedule. And I said it before many times, these quote-unquote Franken products out there that attempt to replicate existing futures position, whether it's VXX or USO or a bunch of other ones, they all do it with varying degrees of success. They all suffer from issues like roll yield, and right now the contango is absurd in the futures, and so of USO, or I should say the WTI futures, and so USO is really getting hurt by that, but they're out of the front month, so that wasn't them. They rolled a while ago. In fact, they changed their prospectus not too long ago to allow them to take about a 20% position beyond that second month out, so they're actually out in July right now, so they're out there in 2 months now, which actually usually might take issue with that because you're saying that's going to make USO not perform as well and not track WTI as well. In this case, those were the saner futures contracts. That's where you want it to be as opposed to May. So that actually helped. Of course, now we saw it got halted today. There are issues. There's so much fund inflows. And that's another problem with these Franken products. When they have huge fund inflows, it could cause all sorts of issues. Now they have to buy up effectively all of what's going on out there in WTI. And there are position limits. USO can't hold more than X% of WTI. So again, these Franken products, they're interesting beasts. We could spend the whole show on that, but I know we have some topics we want to get to. So let's get into a little bit of the old options drills.
Well, in boots, time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
All right, Russell. The fun thing about this show is that even if you're talking dire things like you were at the top of the show here, it always puts you in a good mood because the music is just so cheerful, so happy. So 4th of July, if you like celebrating. Of course, this is Options Drills, the portion of the show where we break down a specific strategy or technique and tell you how you can utilize these in your own portfolio. Today's topic is one of interest to a lot of people out there. Russell, people have been writing into us. Obviously, as you might imagine, ever since the meltdown began in February, and certainly in the teeth of it getting into March there, people were hitting us up saying, hey, vol is high. I want to, quote-unquote, harvest the old risk premium by selling some short puts, either by themselves, naked short puts, or doing them as put spreads. But understandably, people were scared. They were saying, well, I don't want to proverbially catch the falling knife out there, sell a put at a certain strike, and then have the stock blow right through that strike and keep on going. So there was a lot of people writing in saying, what are some ways we could still harvest some of the old risk premium without maybe perhaps diving into the fire too aggressively. So one of the ways we've been utilizing, maybe you have some of your own suggestions as well. One of the interesting ways we've been exploring is something called, there's a lot of different terms for it, listeners. We like to call it just a straight up ratio put spread. And what it involves, remember, a short put, you're just selling a put at X strike. Let's say XYZ stock is trading $50. You want to buy it at 45. The 45 put, let's say, trading for 50 cents. You sell it for 50 cents. You've agreed to buy XYZ anytime in the life of that option up until expiration at 45. So above it, It doesn't make much sense below it. You're going to buy, you have the stock put to you. And effectively, your break-even price is going to be $44.50 because you collected 50 cents on that. But of course, if it blows through all the way down to, let's say, the 40 handle, you're going to be left holding the bag there a little bit. Now, one way to potentially give yourself a little bit more cushion is what's called the ratio put spread. So let's go back to the same example. Now, XYZ trading at 50. You're a little bit nervous out there at the 45 strike, so maybe instead you turn around and you buy the 50 put now. That, of course, in our example is going to be trading for $1. We like nice round numbers here. And then you could turn around, instead of selling one 45 put, you could sell two 45 puts. And in our example, and it lines up neatly in life, very rarely does it do so, but for our example, it does. Where if you sell two of those, now you can do the math, pay $1, collect $1. Your net outlay is zero for this spread. What have you done? You put on a $5 spread effectively for nothing. So if it drops down to 45, you effectively have a spread now worth $5. So that's a nice little $5 worth of profit or revenue cushion that's going to cushion you to the downside. So if it does break through that 45 handle, remember now, you have a spread on, but you also have an extra short put. You're going to be effectively long the stock below that 45 strike going forward. So if XYZ closes below 45 and expires below 45, then you're going to be picking up the stock at that price for one extra put. So you can see as it trends down to about the 40 handle, that's about where your new break even is going to be because you have the profit from that first spread that's going to pay for the losses all the way down to about 40. So the plus side of this trade, of course, you get a little bit more cushion to the downside, which is what people want in this environment. The downside, obviously, if you just sold the 45 put, you're collecting 50 cents. If the stock takes off, 50 cents is in your back pocket at least. If you're doing this ratio put spread, you're not collecting anything. So the amount of premium you're going to collect from this strategy, a wee bit less. Before I break into some other ideas with this, Mr. Rhodes, is this a strategy you like and employ? And if so, when? Or if not, why, sir?
Well, it is a strategy that I like, and it's one that I think you should definitely give some consideration to, especially on the heels of some sort of a sell-off. And the reason I say that is because you start to, you gave us some really nice, fun round numbers there, where you're paying $1 for the 50 put, and you're getting 50 cents each for the 45 put. So there was no, other than commissions, there was nothing involved in this trade. When we end up in these higher volatility periods like we've got right now, you tend to see skew move to the upside as well, which means you don't end up with nice round numbers when you're buying a put and selling a couple at a lower strike price, but you're probably taking in a small credit. And I typically, when I look at trades like this, even though there's downside beyond when you go way beyond the lower strike, I like to do these things at a credit. When I used to do nothing but teach classes at SIBO and I would do these examples, I always wanted to find an example that you could put on at some sort of a credit. And when we've got the implied volatility of farther out of the money put options at a distinct premium because everybody's looking around for ways to insure their portfolio against a farther drop, it gives you the opportunity to do something like that. And then another thing that if you're really okay maybe with holding the stock, and there's nothing wrong with selling some out of the money put options, but I do think you want to go a little bit farther out of the money, just in buy something, because if let's just say we're okay with buying the stock at 40, so we sell that, or I'm sorry, 45. So we sell that 45 put, and for a few pennies we could pick up maybe like the 35 put or something like that. If we get a dramatic drawdown in the market, you might be able to sell that 35 put because, again, you're okay with owning the stock at 45. But with the big spike in volatility, you might be able to take advantage of somebody's panic and sell the long leg, which is a little bit farther out of the money, and offset your ultimate cost for buying the stock.
Yeah, there are a lot of ways you can play with the ratios, and I'm always leery to bring up ratio-type spreads because once people start to really learn and discover ratios, it could easily get out of hand if they're not careful. If you're saying, well, in this case, if I'm 1/2, I'm even. What if I do it 1/3? Well, then I'm collecting 50 cents. What if I do it 1/4? And so the ratios start to get a little out of hand once people start discovering the magic of that leverage on the ratio leg. So in general, listeners, you want to do this where it's favorable. If you are comfortable just buying the underlying outright at a particular strike, there is nothing wrong with selling a put out there. Again, we talked about it on the show many times. If you're okay taking the underlying at that level, you should be comfortable selling that put there. If you're a little bit worried about that level, then maybe you could either adjust your put down. That's always a possibility as well. Or in some scenarios, this type of trade, this ratio put spread, also makes a great deal of sense. I agree with Russell. If you can get it on for a credit, it's even more desirable, because then you are getting a little bit of that premium in your back pocket. So in case it goes against you, in case really it goes the other way and you miss it completely, they have a little bit of premium there. Ease your pain, of course. And then to the downside, of course, that'll always help with a little bit of cushion as well. So there's no really complete rule book on how to construct these perfectly. It's going to change depending on the underlying, on the volatility skew, a bunch of other different scenarios going on out there. But just a rule of thumb, something to consider out there right now. If you are, like many people out there, looking at perhaps trying to find ways to start nibbling at the market, but you're a little bit nervous, maybe you're looking at selling puts, but again, you're not exactly sure what a safe, I put that in quotes because I don't know if there are any safe levels right now. Who knew WTI could go negative? So we're in that type of environment, listeners. But that said, if you want a little bit more cushion, then this ratio put spread could be one option for you. And another option for you is to hit us up with some questions. We got a little bit of time left to see if we can squeeze in a little bit of your mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, we're coming up against it here, Mr. Rhodes, but before we go, I thought it'd be fun. Just there's so much madness out there in the broad world and indeed the broad market. It can kind of be overwhelming. So I thought we would break it up a little bit and insert a dose of fun, a little dash of levity out there, sir. So we asked people this week on our Twitter poll, there aren't many movies set in the world of floor trading, but we managed to scrape together a couple of the standouts out there. Quick, easy, simple question. What is the greatest floor trading-based or oriented movie of all time? We gave him 3 choices, Mr. Rhodes, plus the option to submit some more. We gave him Quicksilver, a little-known Kevin Bacon bicycle messenger drama where he walks onto the Pecos with a visitor's badge. It's fantastic. Rogue Trader, where Ewan McGregor is Nick Leeson over there. And then we have, of course, Trading Places. Mr. Rhodes, if you have a favorite, or perhaps even better, some long-lost gem that we overlooked for our list, have at it, sir.
No, and in fact, I did not answer the survey because I thought you might try to grill me on, which one was most popular. I really liked Quicksilver. I thought, and the reason I liked it is they were so politically incorrect, and they said things in that movie to each other on the trading floor that we would say back in the day. Making fun of somebody's ethnicity or something like that.
The good old days of racial slurs.
Yeah, I mean, and it's like I watched that movie with my wife a couple of years ago, and there were a couple of times that we just looked at each other like, did he just say that about, certain ethnicity always being guilty about things? It was just like, oh my God, we were just blown away by that. But I felt like they really did an accurate job of depicting the floor. I think they did a great job of depicting the floor in all 3 of those movies. In Trading Places, everybody thinks it's just great that Eddie Murphy can show up, and he basically knows how to check his trades at the end of the day after being there for, 4 hours or however long Orange Juice is open. But I was always a big fan of Quicksilver. Also, because I've always been a big fan of the option market. That was an early on option market. And then also, finally, because he was able, as you said, to walk on the floor with a visitor's badge and trade. Years and years and years ago, my parents were in San Francisco, and I asked my mom to grab me a sweatshirt from the Pecos, from the gift shop. And being the forceful woman she was, she actually ran out on the floor and said, "Could somebody tell me where to find a sweatshirt?" And I just always loved that vision of my mother.
There you go. Since you set it up so nicely out there, I will make you guess as well. What do you think is winning, sir, our poll?
Oh, I'm sure Trading Places is winning.
Turn those machines back on, baby. It is. That's the one I would literally hear every day at the close of the SIBO. Someone thought they were clever and would yell, "Turn those machines back on." So yes, that's the one that is pretty much synonymous with the floor trading, where it is blowing the door at 73.4%. Better turnout for Rogue Trader than I thought, about 11.5% and about 7.6% for Quicksilver. About 7.5% saying other. If you're saying other, send in your other. What is the other you want us to? We'll discuss it. Let us know here. But that's about all the time we have for this quick episode. Don't worry, I know you have a lot of questions, so we're going to get to a bunch of them. The whole next episode is going to be devoted to them. But before we go, Mr. Rhodes, if folks want to check out what you're cooking up over there in the land of EQ derivatives, where should they go? What should they do?
Well, two places. You can go to eqderivatives.com. It's a subscription site, but I'm contributing to the NASDAQ blog now. So there is I think you put things in show notes. We'll find out the direct link to me on NASDAQ. I actually just did my first posting this week where I talk about earnings and how that actually impacts NDX options in addition to the bigger components of the NASDAQ 100 when they report earnings.
All right, check them out over there. Just go to NASDAQ, actually, if you know where to find Jill's stuff and all the content there in NASDAQ land. Sounds like you can find Mr. Rhodes over there as well. On behalf of Russell and Dan, who will be back with us soon, and indeed our friends over there at NASDAQ, and myself, I want to thank all of you out there for downloading, streaming, subscribing, for listening live. Keep those questions coming. We're going to dive into them all in the next episode, and we'll see you back here next time for more Options Bootcamp.
Options Bootcamp is brought to you by NASDAQ. From its inception, NASDAQ has been an innovator and agent of change in the financial markets. It's in our DNA. From the development of electronic trading to our drive to bring enhanced functionality and world-leading technology to our suite of 6 options exchanges, we exemplify customer focus, consistent technology, and streamlined solutions. NASDAQ. Tech forward. Leading the U.S. options market and continually rewriting tomorrow. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.